Let's talk credit cards and credit scores. A credit card allows you to borrow money from a bank or financial institution so you can buy anything you like. Anything. It's different from a debit card because with a debit card, you put in your own hard earned coins and then use those until they finish. With a credit card, the money in there belongs to the bank, so when you use it, you're borrowing real money from the bank. So, the bank decides how much they are willing to lend you, and that's what we call a credit limit. It's basically the maximum amount you can borrow. If you borrow, you always need to pay back. It's not monopoly money. The bank gives you time to pay back. Usually that is about a month, and this is called the grace period. If you pay back the full amount that you borrowed before your due date, you're not charged because you're within the grace period. What is sometimes unclear is when the grace period starts and ends. The grace period does not start the day you use the money. It actually starts on the same day of each month. This is called a bill cycle. In each bill cycle, you want to pay before the due date. So this is how the due date day is decided. When you apply for a credit card, they usually ask you when you are able to make a payment every month. If you tell them that you'll make payments on the 30th of every month, then that is when the grace period ends every month. This means you can pay back everything in full before or on the 30th and not get charged on what you borrow. If you pay anything from the 31st onwards, you're no longer in the grace period. If you don't pay in full, the remainder of what you owe is called the balance. This then means if you don't pay what you used in full, the balance, and you only make a partial payment or miss the due date, you'll be charged interest. This is basically the bank's fee for lending you money, and it's usually charged at a rate called the annual percentage rate, or APR. The longer you take to pay off the balance, the more interest you'll have to pay. If you use a credit card, you can't ever choose to not pay back anything. We will talk about what will happen if you paid nothing towards the end of the video. The bank will set a minimum amount that they want you to pay for every billing cycle that you owe them something. This is called a minimum payment, which is always a small portion or percentage of the whole amount you owe. If you owe nothing, then you pay back a percentage of that. 0 divided by anything is 0. Must I teach you everything? So as an example, if the APR is 12%, that means the monthly interest will be 1%, because remember, it's an annual rate, so 12% over 12 months. This usually means the minimum amount is slightly more than that 1% of what you owe. Maybe say 3%. Anyway, while it can be tempting to just pay the minimum payment set by the bank, since it reduces what you need to pay right away, you should always keep in mind that the rest of what you owe will still accrue interest. So, making just the minimum payment might seem convenient, but it can actually cost you a lot more in the long run. Okay, let's do the math. I'll teach you everything. Say you go to the bank and they are willing to give you a credit card with a $2,000 limit. They will charge 24% interest, which we now know means 24% over the 12 months is 2% every month. You both agree that your payments are due on the 30th of every month and your minimum payments are 3%, which conveniently is always above the monthly interest rate. You go ahead and swipe that card for a Louis V bag that costs $2,000 in July. If you pay back the $2,000 before or on the 30th of July, then there is no issues. You can use that $2,000 again and again, which is why credit cards are categorized as revolving credit. I'll cover what happens if you pay nothing at all towards the end. But if you are like most people, you pay back the minimum amount, which in this case is 3% of what you owe, and that's $60 before or on the 30th of July. The bank will take your $60 and split it into interest payments and what they call principal payments. We already know that the interest would be 2% of $2,000, which is $40. So, the principal payment is the remaining $20. This means your balance only reduces by $20 even though you paid $60. Since it's revolving credit, this also means you only have a credit limit of $20 for August. If you had paid more than $60, say you paid $500, the interest payment would still be 2% of what you owe, which is still $40. But the difference is your principal payment is the $500 minus the $40 interest, which is $460, which reduces what you owe by $460. In August, you would only have a balance of $1,540 and only get charged interest on that if you don't pay it in full. It would also mean you have a revolving limit of the $460 you paid last month. Credit cards, however, can also sometimes come with additional fees because why not? Right? These are important to understand. Some common ones include late fees, which are charged if you don't pay by the due date. Annual fees, which some cards charge just for the privilege of using them. Cash advance fees if you use your credit card to withdraw cash. These can come with higher interest rates too. Yeah, this one never made sense to me, too. These fees are taken from the money you pay, and you guessed right, they reduce your principal payment. Now, let's talk about the upside rewards. Many credit cards offer rewards like cashback, points, or miles for every purchase you make. These rewards can be redeemed for things like travel, gift cards, or even statement credits. It's a way to get some value back from your purchases, but always remember, if you're paying interest or fees, those rewards can quickly be outweighed by costs. So don't spend more than you should trying to chase those shiny rewards because, come on, spending $2,000 to get $20 cash back while paying $30 in fees? Only if you have to. Okay, but what happens if you decided not to pay any of this? Or for some reason you fail to pay? Enter credit scores. You literally get a score for how well you are managing your credit. Don't think of it as a report card because anxiety. It's basically a game. I will teach you the rules of the game. Anyway, a credit score is a three-digit number that represents how reliable you are when it comes to borrowing money. Lenders use this score to decide whether or not to even give you a loan or a credit card at all. If they do give it to you, they use your score to decide what interest rate they will charge you. Your credit score is based on several factors. Payment history. Have you paid your bills on time? This is the most important factor. Credit utilization. How much of your available credit limit are you using? Using less than 30% is considered healthy because the question is always, why are you borrowing so much? Length of credit history. How long have you had credit accounts? The longer, the better. That's what she said. Credit mix. Lenders like variety and like to see that you can handle different types of credit, like credit cards, auto loans, or mortgages. Mix it up a little. New credit. Opening too many new accounts in a short period can negatively affect your score because, again, why are you borrowing so much? Right? Also, no one trusts speed daters. If you know, you know. If you want the numbers and more about how credit scores are calculated, then watch out for my video where I go into the nitty-gritty details.